Hello, in this video we're going to look at the user cost of capital. So let's define three terms here. P subscript K is the real price per unit of capital. D is the annual depreciation rate of capital. And R is the real interest rate. The interest cost of using capital is going to be the real interest rate times the price of capital. So let's say you borrow $1,000 to buy capital at a real interest rate of 8%. The interest cost of using capital will just be $80 per year, 8% of 1,000. On the other hand, if you used retained earnings from the firm and bought the capital using $1,000 of cash, there's still going to be an interest cost of using capital, in this case foregone interest income. You can invest those $1,000 in an interest-bearing account that pays 8%. So it's still $80 per year in terms of an interest cost of using capital. In this case, this is an implicit cost, but nevertheless, it is a relevant cost of using capital. So the interest cost of using capital is the same regardless of borrowing or paying cash. Now, the depreciation cost of using capital is going to be the depreciation rate times the price of capital. So if you buy $1,000 worth of capital, and by the end of the year that capital is now only worth $900 because of wear and tear, you suffered a 10% loss in the value of capital. So the depreciation cost of using capital is going to be the depreciation rate times the price of capital, in this case $100 per year. So the user cost of capital just sums up those two components, the interest cost of using capital and the depreciation cost of using capital. So in our example here, the user cost of capital would be $180 per year. Now let's look at the desired level of capital stock. We need to define the marginal revenue product of capital, or some might call it the value of the marginal product of capital, and that will equal the user cost. So in terms here, the ideal or desired level of capital stock occurs when the marginal revenue product of capital just equals the user cost of capital. Keep doing something up until the point where the added benefit just equals the added cost. And so the marginal revenue product of capital is the added revenue, or the value of output, from the last unit of capital. And we would expect this to diminish as we keep purchasing and using more units of capital. The added revenue from the last unit is likely to fall. So an example problem. So let's say that the marginal revenue product of capital is given by the following equation, where K is units of capital. We have a real interest rate of 10%, depreciation rate of 15%, and the price of capital is $100. How many units of capital should this firm hire or use? Set the marginal revenue product of capital equal to the user cost. So making our substitutions here, the left-hand side is the equation for the marginal revenue product of capital. And on the right-hand side, we got the real interest rate times the price of capital plus the depreciation rate times the price of capital. Simplifying. 250 minus 25 is 225, and solving for K, we get K equals 450. So we'd use 450 units of capital in this case to maximize profit. Now let's talk about the desired level of capital stock with taxes, or the tax-adjusted user cost of capital. So 1 minus the tax multiplied by the marginal revenue product of capital will equal the user cost in this case. And here the tax is going to be the tax rate on the firm's revenue. So just making our substitutions. And we're going to just divide everything through by 1 minus the tax. On the right-hand side, we got our tax-adjusted user cost of capital. And so an example problem. Basically the same setup as last time, but now we're dealing with a tax here of 25%. So making our substitutions and simplifying, the desired level of capital will be a little bit lower in the face of a tax. Okay, that's it. I hope you found this video helpful.